even percent. He has said we have to monetize the asset side of our balance sheet. It doesn't mean repricing gold at 20,000 to pay some debt. There is a reason the East, and China in particular, are stacking so much copious amounts of gold on a fire sale thanks to the COMEX. Everyone's distracted by AI, NVIDIA, and the S&P. What's really happening is with the US dollar, gold is no longer just an allocation. It's going to be a part of a global net trade settlement. It's more than just QE and yield curve control. There's going to be a letting gold run moment, which is why I don't mind buying it at 4,000, 3,000, or 6,000, because I see gold. It's the home of the sacred 10-year US Treasury. When those yields start spiking, as they've done this year, that's a clear indication of distrust in the IOUs of Uncle Sam and in the 10-year US Treasury. A government like the United States starts seeing the 10-year at 4.7 without the Fed having to raise rates. This, again, is the world telling the US that we don't trust your IOUs like we did before because you're 40 trillion in public debt, over 100 trillion in unfunded liabilities. I think, yes, we're going to lead to direct QE, shameless QE, shameless yield curve control. We will have no choice. And none of us can time the pin prick that hits that balloon and forces it. I think it's also important. I'm not saying this as a gold executive, which I've been for years, or just a shill for precious metals out of Switzerland, but looking at this economically, and we'll talk about the social unrest too, but looking at this economically, it is very much now in the U.S. interest to do what China's been doing for decades, since 2014. Again, it doesn't mean a gold-backed dollar. We're not going back to that. But what is going to happen with all this QE to come and all this yield curve control, America in particular, the home of the U.S. world reserve currency, is no longer looking at gold. There's a fight between what they call it the Hamiltonians and the non-Hamiltonians, but it's going to be very obvious to me when you see decade and then year and then quarter after quarter of central bank gold stacking and Chinese gold stacking, whether it's 100 tons, 110 tons, 200 tons, the level of gold stacking by China, again, far-sighted, is a quiet indicator, using the military analogy of an army putting its tents closer and closer to the river and their cavalry coming closer and closer to the river. There's something going on. There is a reason the East, and China in particular, are stacking so much copious amounts of gold on a fire sale thanks to the COMEX and CME in February. But there is a reason they're buying this gold. It's not just because it's a nice allocation. They see a world where fiat money, including the US dollar, is going to be less and less influential, and that more and more trade will be needed to be net settled in gold.
If gold becomes the escape valve, while debt expands, savers could discover that cash was never the safest asset. Matthew Piepenburg notes that Chinese and central bank accumulation points toward a world where gold carries settlement power. The overlooked issue is whether policymakers need higher gold prices to stabilize balance sheets. For investors, that could transform gold from insurance into monetary infrastructure. Next, Matthew Piepenburg exposes why the East may be positioning for a currency regime Wall Street dismisses.
Even the US, even percent, the Hamiltonian that he is, even he has said we have to monetize the asset side of our balance sheet. It doesn't mean repricing gold at 20,000 to pay some debt. It means letting gold run naturally without the artificial interference of the COMEX and the LBMA markets. Because at some point, our strategic gold reserves, whatever that is, we haven't had it audited, need to be repriced to market. The higher the market price of gold, the more we can de-deficit certain key areas of our economy. Gold will no longer be the enemy as it was under Volcker, where they literally called gold the enemy and therefore artificially repressed it. In the years to come, whether we like it or not, we're going to have to follow China's lead and start repricing our gold and our gold reserves at a higher price. We're going to need a higher price. So I think that's an interesting part. Again, everyone's distracted by AI, NVIDIA, and the S&P. What's really happening is with the US dollar, gold is no longer just an allocation. It's going to be a part of a global net trade settlement. It's going to be the new world reserve kind of asset. And that's not, again, sensational. It's literally happening in front of our faces right now. US Treasuries now are less held by central banks than physical gold. That is such an obvious signal of the cavalry charge, and no one wants to see it, and certainly no one wants to talk about it openly. So that is more than just QE and yield curve control. There's going to be a letting gold run moment, which is why I don't mind buying it at 4,000, 3,000, or 6,000, because I see gold multiples of that in my lifetime. But in terms of the social unrest, again, the syllogism, the daisy chain from a debt crisis to a currency crisis, which is an inflationary crisis, always leads throughout history to social unrest. And that always leads to increased centralization from the political extremes of the left or the right. The left or the right.
Wall Street can celebrate AI while the monetary system quietly changes underneath it. And that contradiction deserves attention. According to Matthew Piepenburg, repricing official gold could absorb fiscal pressures without formally abandoning fiat currency. That would make gold's price part of the policy mechanism, not merely a hedge. For savers, the danger is owning assets priced for yesterday's rules. Next, Matthew Piepenburg reveals why rising gold could eventually strengthen the system investors think it threatens.
There was Spain, Russia, the UK. We've all seen this movie before. What we're seeing is centralization hiding in plain sight through CBDC, which is not CBDC. It's stablecoin issued by private issuers instead of central banks, but it's the same thing. It's programmable, trackable money. We're going to probably see more capital controls on flows of money in and out of certain countries with certain assets. We're going to see less and less civil liberties and more political spin and more mis or disinformation from our so-called media, private media. That has everything to do with why they're stacking gold and why they're avoiding wars and that's a whole gold discussion. But, the Chinese is a preferred source of funding for the global south, for the BRICS. They do have a relatively higher liquidity and more stable currency and lower funding costs than other partners or other players. And this is very attractive to developing nations like India or Indonesia or Malaysia or Latin America. So just this year alone, I think the new development bank, the BRICS Bank, China had 25 billion worth of yuan-backed loans. So China is getting more credibility. Its bond market is nothing like the U.S. bond market. Its reputation hasn't built anything like the history of the U.S. or the Western system. But they're playing the long game, and they are considered a better source of short-term funding for liquidity and funding costs than many other Western currencies right now. And therefore, their yields are tighter or more compressed than the UK gilt or the US Treasury or the Japanese JGB. That isn't, again, to say that China has won. What it is saying is and you could look at the petrodollar, you can look at gold stacking, you can look at the new trade settlement systems in Shanghai and Hong Kong.
China does not need to win outright if Western debt keeps weakening confidence in fiat. What Matthew Piepenburg is highlighting is the expansion of yuan-backed financing and alternative settlement infrastructure across emerging markets. Liquidity and funding costs can reshape trade relationships before headlines acknowledge a regime change. For investors, that can eventually alter Treasury demand and strengthen gold's strategic role. Next, Matthew Piepenburg unravels why BRICS financing may matter more for capital cost than ideology.
There's so many indications of China patiently watching us shoot ourselves in the foot as they build infrastructure, build their bond market, support, not back, but support trade in gold rather than fiat money, net settle trade. They're thinking decades ahead. And so we're going very clearly into a multipolar direction where China's going to have a...
Well, you've been saying for more than 10 years now that the bond market is everything. And right now we see 30 yield treasuries at their highest level since 2007 at 5.3%. Japan 30-year bond yields at 4.1%, the highest since its introduction in 1999. So do you feel vindicated? And why are bond markets so important?
They are so important, and I've been pounding my fist on this, like many others. I'm certainly not alone, for years. And it's not a broken clock or a cry wolf. It's just watching the slow trajectory of distrust in sovereign debt. And I always caveat by saying many people consider the bond market boring or complex, and it certainly can be. It's actually quite easy in a lot of ways to understand the basic drivers. And I think a lot of it is overlooked because we're distracted with so many legitimate headlines in so many other areas, whether it's in a ripping S&P or a Fed-based tech market or Fed-supported stock market or war headlines or AI or stablecoin. There's just so much noise. Some of it's very important that who wants to talk about bond yields? And it's understandable. But, just again, for very simple, many people know this very well. Some are newer to it. Bond yields go up when bond prices go down. And bond prices go down when there's less demand for bonds. And the bonds are the IOUs of the big governments. And so when you see rising yields, what that really means is a declining trust in government IOUs. So you talk about these decade highs across the sovereign bond markets, in particular the US, because it's the home of the world reserve currency.
The bond market becomes most dangerous when investors are distracted by stocks. Matthew Piepenburg's argument suggests rising yields are not merely a rate story, but a confidence test on sovereign debt. Higher borrowing costs spread through mortgages, corporate financing, and government budgets. For savers, that pressure can quietly erode purchasing power, even without an obvious crash. Next, Matthew Piepenburg exposes why the next bond market warning could arrive before equities react.
It's the home of the sacred 10-year US Treasury. When those yields start spiking, as they've done this year, that's a clear indication of distrust in the IOUs of Uncle Sam and in the 10-year US Treasury. It's more than just a sign of distrust, though. It's a sign of massive ripple effects, because when a government like the United States starts seeing the 10-year at 4.7, without the Fed having to raise rates, this again is the world telling the US that we don't trust your IOUs like we did before, because you're 40 trillion in public debt and, over 100 trillion in unfunded liabilities. Your IOUs aren't as trusted. We require a higher risk premium or return to lend you money or to take your bonds. That's pretty embarrassing for the home of the world reserve currency. It's more than embarrassing. It's expensive, because when yields rise, the cost of everything from mortgages to car loans to government debt becomes more and more difficult to repay. Now, for the average citizen in any part of the world, whether it's in Italy or the UK or France or certainly the US, rising rates are very painful and they're hard to pay. And mortgages are harder to pay, and car loans are harder to pay. But for governments, the easiest way around that is just to literally manufacture out of thin air synthetic liquidity. So you can always pay your debts. You can always avoid default, but you do that by debasing the currency, which is another form of inflation. It's an invisible tax on the citizen. So it's a vicious circle that hurts everyone, but in particular the man on the street or the investors the most. And when yields rise, that makes refinancing and debt, when stock purchases and stock buybacks on the stock market more expensive. It makes everything more expensive in a debt-based world. So it threatens every asset class. But in particular, it threatens the currencies. Again, whether that's in the EU, whether that's in the US, you have to find ways to do non-QE, QE, to create synthetic liquidity or create liquidity for the bond market to keep bond prices bought when no one else is buying them.
A 4.7% Treasury yield can hurt the economy even when the Fed refuses to raise rates. This is where Matthew Piepenburg's thesis shifts toward currency debasement as the escape mechanism. Governments can manufacture liquidity to avoid default, but the cost transfers through weaker purchasing power and inflation. For households, that hidden tax can rise while markets appear stable. Next, Matthew Piepenburg reveals how Japan's treasury selling could intensify that pressure.
And you do that by debasing the currency. So there is a direct effect on anyone listening, especially whether you're buying or selling or taking loans in US dollars. It's the same thing for euros. That purchasing power, that dollar, that euro is buying less and less. It's being debased more and more. So in addition to your taxes that you're paying, you're being invisibly taxed through this very boring thing called debasement, which again, we at Von Greyerz have been talking about for years. The pace of it now is accelerating. So when I see the 10-year US Treasury over 4.7, that becomes very scary. We can talk about the more specific details. The DXY isn't really ripping well to the milkshake theory levels of Brent Johnson, despite a 10-year yield at 4.7. Again, boring things like yields can be simplified to very simple things. It makes the cost of debt harder to pay for everyone, including the governments. It makes your currency weaker. And ultimately, it's a direct threat to this supposedly immortal stock market in S&P, which we can talk about too. But it is very, very important. And when you see currency debasement, of course, slow, steady, incremental, and then, as Ronnie Sturfel is incremental, but then it becomes exponential. And that's when the real problems hit and the social unrest comes. It's all tied together. And it's all about the bond market. Again, boring, but very, very important.
Yeah. And like you said, it's all about supply and demand. And we've seen Japan selling a lot of treasuries. In May, they sold on a net basis 62 billion. Yeah. Insane amount, because they still own around 1,100 billion, but the 62 is a huge number. And then end of last month, we saw Japan intervening again, this time together with the US. What are your thoughts on the whole Japan situation and what's going on there?
It's a headline for a reason. It's also somewhat boring to many, but it needs to be understood because Japan was the biggest foreign holder of US treasuries, US IOUs. Now it's a massive seller.
Japan selling $62 billion of treasuries in 1 month is not background noise when its system depends on dollar funding. According to Matthew Piepenburg, defending the yen can force Japan to liquidate dollar assets, pushing treasury prices lower and yields higher. America then absorbs pressure created by an ally stabilizing itself. For investors, Japanese flows can matter more than another inflation headline. Next, Matthew Piepenburg exposes why Washington may be forced to support Japan.
And the story of Japan and the story of the yen and the story of the US and the story of the dollar are very linked. They kind of require each other when they're cooperating, but they can very much hurt each other. When Japan is trying to support its own yen, after years of living on synthetic liquidity and a debt to GDP ratio in the 280 range, depending on what information you look at, Japan is a zombie since the Nikkei crashed in '89, and they've been supporting their bond market through printing money on a handbook from Bernanke. And I think that's debased their currency to such an embarrassing level. It was always a question of when, not if, Japan, which has had 0% interest rates for years, would have to raise rates even a small amount to try and support its yen. It would have to sell a bunch of US treasuries to get liquidity to buy more yen, billions and billions. And when it sells US treasuries, that sends the US treasury price down, and it hurts the US because then our yields and rates start to go up and our expenses have to go up. So in a sick, twisted way, the US is forced to bail out Japan to bail out itself, or at least attempt. I mean, the Japanese have had so many finance ministers and central bankers over the years, they kind of rotate out in and out so quickly. But the U.S. is literally printing money to buy U.S. treasuries that the Japanese are selling to support their yen. And there's been these, they call them repurchase agreements or UAE swap lines. Again, they're meant to be complex and boring, so the average very smart American or European citizen doesn't really have time to dig into it. It's really just yield curve control. It's really just indirect QE. America is giving billions to the Japanese in some form, or they're directly buying the treasuries that the Japanese are selling, so that the American bond market is supported. Because without Japan's help, which has been there for decades to buy our IOUs, our unwanted IOUs, without Japan's help, we then have to do it ourselves.
The real danger is not Japan selling treasuries, it is Washington absorbing the consequences indirectly. Matthew Piepenburg notes that swap arrangements and repurchase facilities can support markets without carrying the political label of quantitative easing. Investors may underestimate intervention when it arrives through financial plumbing instead of headlines. For portfolios, hidden liquidity can postpone stress while increasing currency risk. Next, Matthew Piepenburg unravels why yield curve control can exist without being officially announced.
And so we create these swap lines or these boring repurchase agreements, which is effectively indirect QE. It's yield curve control because we don't want to see our 10-year go to 4.6, 4.7, 4.8, 5, because at that point, we literally can't afford the debt at 40 trillion. So the Japanese rate hikes and the Japanese selling of U.S. treasuries has a direct effect on the world, on the U.S. dollar. It also has a massive effect on the U.S. stock market because the Japanese are major buyers of U.S. treasuries, but their quote-unquote net international investment position means that they use a lot of their yen and to buy dollars to buy U.S. stocks. When they reflow that money back to Japan, because it's back to every man for himself now, everyone for themselves, that takes a lot of money out of the U.S. markets too. And the U.S. markets are the only good story America has right now. And when the Japanese flows, if these flows continue, that can be a massive disruption to the U.S. And this kind of, I hate to say it, bugger thy neighbor currency crisis. We're not the America and Japan or the West of 1985 and the Plaza Accords, where we can get together and try and really cooperate, because I think Japan is, it's like Japan and the U.S. I think Lou Groman said they're like two partners on a sinking ship, and they're handcuffed to each other, and yet they're really not cooperating. And I think that's a very good analogy, and you've just seen Warren Buffett dump $285 billion of Japanese government bonds just before they announced a new debt ceiling. So there's a lot of tension right now, but we're losing Japanese support for our treasuries. That means our yields and cost of debt are going up. There's a massive flow of Japanese money coming out of the S&P and back to Japan, which is why we saw the worst NASDAQ numbers in July recently that we've seen in years. That's all connected. And we also have lost the quote-unquote Japanese carry trade, which can get very complex. It was very simple. It was cheap lending for the world for a currency arbitrage.
The Japanese carry trade was global fuel, and its reversal threatens more than the yen. What Matthew Piepenburg is highlighting is the chain from Japanese rate pressure to Treasury selling, weaker liquidity, and US equity outflows. When cheap yen financing disappears, leveraged investors lose a funding source supporting risk assets. For ordinary investors, a foreign policy shift can reach stocks and bonds directly. Next, Matthew Piepenburg reveals why Japan and America may be trapped together.
What that meant when Japan had 0 to negative interest rates, the world, including the US hedge fund world, the shadow banking world, would simply borrow in yen for almost nothing or negative, buy US dollars, and then leverage those dollars to invest in the stock markets. That free money is now over. The carry trade is now over. So again, it's not just what it does to the yen or to the cost of US debt and to US Treasury yields. It affects the stock market, which I've said is the only strong narrative the U.S. has for its so-called strong economy, which they've confused with an S&P that is, by every indicator is massively overpriced. So we're tiptoeing not in a cry wolf way. We're tiptoeing not into an in futuro problem. We are in a problem right now. We are in a very, very fragile market in our debt markets. We are in a very fragile market in our equity or stock markets. We are in a very fragile market with currencies. And this explains why precious metals, despite the price action of the first quarter, is just the direction of the international hockey puck longer term. And for us at Von Greyerz, who are long-term preservationist thinkers, this is an easy pitch. It's a fat pitch to buy gold on a fire sale right now, because the credit markets, the equity markets, and therefore the currency markets are under so much obvious stress, complex, foggy, noisy, ignored, but ticking away right underneath us as we speak.
Near zero Japanese rates turn borrowed yen into fuel for global speculation, and that fuel is disappearing. Matthew Piepenburg's argument suggests the carry trade reversal can expose vulnerabilities hidden by cheap financing rather than genuine strength. If leverage money retreats, overpriced equities and fragile debt markets can reprice together. For wealth preservation, liquidity risk becomes as important as headline returns.